Imagine a financial analyst who predicted the collapse of Lehman Brothers months before it happened. Imagine someone who warned about the 2008 financial crisis while others celebrated endless growth. Now imagine that same person telling you that silver will reach $250 per ounce before gold even touches $10,000. This is not a random prediction from an internet commentator seeking attention. This is Jim Rickards, and his track record demands that we pay attention. Rickards' forecast defies conventional wisdom. In the minds of most investors, gold leads and silver follows. Gold is the king of precious metals, the ultimate safe haven, the store of wealth that has endured for millennia. Silver, in this narrative, is gold's smaller sibling, useful certainly, but ultimately secondary. It moves in gold's shadow, rising when gold rises, but never surpassing its larger counterpart in percentage terms. What Rickards is suggesting represents a complete inversion of this relationship. He's arguing that silver will not merely keep pace with gold in the coming monetary transformation. He's stating that silver will outperform gold so dramatically that it reaches a price most analysts consider impossible, while gold remains well below levels that many already consider inevitable. To understand why this prediction isn't madness but mathematical logic, we must examine the forces reshaping silver's role in the global economy and financial system. Quick disclaimer, because this matters. This is not financial advice. This is market structure education and macro analysis documenting unusual price behavior and what it might reveal about underlying stress. I'm not telling you to buy or sell anything. I'm not recommending positions or strategies. I'm not claiming I know with certainty what caused yesterday's move. Do your own research and consult qualified professionals before making investment decisions. The prevailing narrative about precious metals is simple and widely accepted. Gold is the safe haven. When currencies weaken, when geopolitical tensions rise, when inflation threatens purchasing power, investors flee to gold. This pattern has repeated throughout history, creating reflexive behavior among market participants. At the first sign of trouble, capital flows into gold, driving its price higher and confirming its status as the ultimate monetary metal. Silver occupies a different position in this conventional framework. It's recognized as a precious metal with monetary history, certainly. Silver coins circulated for thousands of years, silver-backed currencies alongside gold in bimetallic systems. But in the modern era, silver has been demoted. It's viewed primarily as an industrial commodity that happens to retain some monetary characteristics. When investors want safety, they buy gold. When they want industrial exposure, they might consider silver. This dual nature is seen as a weakness rather than strength. Silver doesn't excel at either role because it's caught between two markets. This conventional thinking contains a fatal flaw. It treats silver's dual nature as a liability when, in fact, this characteristic positions silver for extraordinary performance in the environment that's currently developing. The world is not heading toward a simple financial crisis where investors seek safety in traditional stores of wealth. The world is simultaneously experiencing a monetary crisis and an industrial transformation of unprecedented scale. Silver is the only major commodity positioned at the intersection of these two massive trends. Jim Rickards built his reputation on seeing connections that others miss and understanding how systemic pressures create inevitable outcomes regardless of what policymakers or market participants might prefer. His analysis of silver begins with a fundamental observation. The metal is being pulled in two opposite directions by forces that are both accelerating. On one side is the monetary demand. As governments worldwide engage in competitive currency debasement, as debt levels reach points where traditional solutions become impossible, as confidence in fiat monetary systems erodes, investors seek alternatives. Gold captures most of this flight to safety demand because of its established role and larger market. But Rickards points out a crucial dynamic that most analysts overlook. Gold's very success as a monetary safe haven is creating conditions that will drive massive flows into silver. When gold was trading at $300 per ounce, it was accessible to average investors globally. A single ounce represented perhaps 2 weeks of wages for a median income worker in developed economies. As gold approached $2,000, then surpassed it, this accessibility disappeared. An ounce of gold now represents a significant sum that many investors cannot commit to a single asset. This creates a natural ceiling on retail participation in the gold market that doesn't exist for silver. Silver, trading in a range that still allows ordinary investors to accumulate meaningful positions, becomes the accessible alternative. Rickards describes this as the poor man's gold effect, but the terminology undersells the significance. This isn't about poverty. It's about the mathematical reality that when billions of people worldwide seek monetary protection simultaneously, the smaller, more affordable monetary metal will see disproportionate demand pressure relative to its market size. The industrial side of silver's demand story has transformed completely in the past 5 years, and most market participants have failed to grasp the magnitude of this change. Silver has always had industrial applications: photography, electrical contacts, mirrors, medical uses. These created steady demand that supplemented investment and jewelry consumption. But the industrial applications emerging in the 2020s are of an entirely different order of magnitude. The global commitment to decarbonization has created a technological build-out that dwarfs any previous industrial revolution in speed and scale. Solar photovoltaic installations are expanding exponentially, driven by both policy mandates and the economics of renewable energy reaching grid parity in most markets. Every megawatt of solar capacity installed requires approximately 20 kilograms of silver in the photovoltaic cells that convert sunlight to electricity. The International Energy Agency's projections for solar deployment through 2030 imply silver demand from this sector alone exceeding 200 million ounces annually, nearly 1/4 of total global mine production. The electrification of transportation creates a second massive demand vector. Electric vehicles use 2 to 3 times more silver than internal combustion vehicles in their electrical systems, charging infrastructure, and power management components. As governments worldwide mandate the phase-out of combustion engines and manufacturers commit to full electrification, the automotive industry's silver consumption is growing from a modest contributor to a major demand driver. By 2030, automotive silver demand could exceed 150 million ounces annually, up from less than 50 million ounces in 2020. The deployment of 5G telecommunications networks adds yet another layer of industrial demand. The infrastructure supporting 5G, base stations, antennas, network equipment, requires silver in quantities that previous generation networks did not. Each 5G base station uses approximately 3 times the silver of a 4G station due to the increased number of antennas, the higher frequencies requiring more conductive materials, and the power densities involved. With millions of 5G base stations being deployed globally, this represents another 50 to 70 million ounces of annual demand. These 3 sectors, solar, electric vehicles, and telecommunications, are adding approximately 300 to 400 million ounces of new industrial silver demand over the next several years. This increase alone exceeds the total annual mine production of many major silver-producing countries, and these are just the most visible applications. Silver's unique properties make it essential in emerging technologies, ranging from advanced medical devices to artificial intelligence computing infrastructure, to Internet of Things sensors being deployed by the billions. The critical characteristic of industrial silver demand is that it is largely price inelastic. When a solar panel manufacturer designs a photovoltaic cell, the silver content is determined by the physics of electrical conductivity and the efficiency requirements of the panel. The manufacturer cannot simply use less silver because the price increased. They can attempt to thrift, use slightly less through more precise application methods. But the gains from thrifting have largely been exhausted. Below certain thresholds, the solar panel simply doesn't work at the required efficiency level. Similarly, automotive engineers designing 800-volt electrical architectures for fast-charging electric vehicles cannot substitute inferior conductors without compromising performance and reliability. The silver is there because it's necessary for the system to function as designed. When manufacturers face higher silver prices, they don't reduce consumption. They pass costs to consumers or accept lower margins. The metal must be purchased regardless of price. This creates a demand curve that conventional commodity market analysis doesn't handle well. Most commodities see demand destruction when prices rise significantly. Higher oil prices lead to reduced consumption as people drive less, industries optimize energy use, and alternatives become economically viable. Silver's emerging industrial applications don't exhibit this behavior. The demand is driven by technological imperatives and policy mandates that governments and corporations will not abandon due to commodity price fluctuations. Now consider the supply side of this equation, and the constraints become even more apparent. Silver mining faces limitations that make rapid production increases impossible, regardless of how high prices rise. Approximately 70% of silver production is a byproduct of mining other metals, primarily lead, zinc, and copper. This means that silver supply is largely determined by the economics of base metal mining, not by silver's own price. When copper mines are profitable and expanding, silver production increases as a byproduct. But if copper demand softens or copper mining faces challenges, silver supply falls regardless of what silver itself is trading at. The correlation between base metal markets and silver supply creates a situation where silver prices can rise dramatically without triggering a meaningful supply response. The remaining 30% of production comes from primary silver mines, where silver is the main revenue driver. These operations can respond to silver prices by increasing production, but their ability to do so is constrained by geology, capital requirements, and development timelines. Bringing a new silver mine from discovery to commercial production requires 7 to 10 years and investment measured in hundreds of millions of dollars. Even expanding existing operations takes years of permitting, engineering, construction, and ramp-up. In the timeline that Rickards is discussing, silver reaching $250 in the next several years, there is insufficient time for new mine supply to respond meaningfully. The decline in above-ground silver inventories adds urgency to this supply picture. For decades, silver accumulated in government stockpiles, private vaults, and exchange warehouses. This inventory acted as a buffer, allowing the market to absorb demand spikes by drawing down stored metal. Throughout the 2010s and early 2020s, this buffer has been systematically depleted. Government stockpiles have been sold or exhausted. Exchange inventories have fallen to multi-decade lows. The silver available for immediate delivery is now measured in months of industrial consumption rather than years. What happens when a market characterized by price inelastic, rapidly growing demand meets a supply curve that cannot respond to price signals in any meaningful time frame? Economics provides a clear answer. Prices rise until equilibrium is restored through some combination of demand destruction and new supply. But if neither demand destruction nor new supply can occur quickly, prices must rise far higher than conventional analysis would predict. Rickards' mathematical framework for reaching $250 silver starts with the gold-silver ratio, the number of ounces of silver required to purchase 1 ounce of gold. Historically, this ratio has fluctuated between 15 to 1 and 100 to 1, depending on monetary regimes, industrial demand, and market sentiment. For most of human monetary history, the ratio ranged between 12 to 1 and 16 to 1, reflecting the relative geological abundance of the metals and their comparative monetary roles. In modern markets, the ratio has varied wildly. During precious metals bull markets, the ratio tends to compress as silver outperforms gold. During bear markets or periods of financial stress, the ratio expands as investors flee to gold and silver's industrial demand suffers. In early 2024, the gold-silver ratio traded above 80 to 1, meaning 80 ounces of silver were required to buy 1 ounce of gold. This extreme ratio reflected silver's underperformance and the market's focus on gold as the primary monetary safe haven. Rickards argues that the combination of monetary crisis and industrial transformation will drive this ratio back toward historical norms and potentially below them. If gold reaches $8,000 per ounce, a level many analysts already consider conservative given debt levels and monetary expansion, and the gold-silver ratio compresses to 30 to 1, silver would trade at $267. If gold reaches only $7,000 and the ratio compresses to 35 to 1, silver reaches exactly $200. The key insight is that silver doesn't need gold to reach $10,000 for silver to hit $250. It needs the gold-silver ratio to normalize from its current extreme levels. And the forces driving ratio compression, industrial demand pulling silver higher independently of gold, accessibility driving retail investors to silver as gold becomes too expensive, the recognition that silver's dual role is an advantage rather than weakness are already in motion. The financialization of silver markets creates additional leverage that could accelerate price moves beyond what supply-demand fundamentals alone would suggest. For years, silver has been one of the most heavily shorted commodities on futures exchanges. Commercial producers, investment banks, and hedge funds have maintained massive short positions, betting on stable or declining prices. These short positions served various purposes: hedging mining production, facilitating ETF creation, expressing bearish views on industrial demand. As silver prices begin rising on fundamental strength, these short positions become liabilities. Holders must either close positions by buying silver, driving prices higher, or maintain positions and accept mounting losses. If enough shorts attempt to exit simultaneously, the result is a short squeeze, a self-reinforcing feedback loop where buying to cover short positions drives prices higher, triggering additional covering and further price increases. Silver's relatively small market capitalization compared to gold makes it particularly susceptible to this dynamic. The entire global silver market, all the metal in vaults, all the annual production, all the ETF holdings, represents a value measured in tens of billions of dollars. This is a rounding error compared to the multi-trillion-dollar gold market or the dozens of trillions in global bond markets. When large institutional investors or sovereign wealth funds decide to allocate even a small percentage of their portfolios to silver, The capital flows involved can overwhelm the market's capacity to absorb demand without dramatic price moves. Rickards points to this size asymmetry as a critical factor in silver's potential for explosive returns. A 1% portfolio allocation to silver by global institutional investors would represent capital inflows larger than multiple years of global mine production. The market simply cannot accommodate this level of demand at current price levels. Prices must rise to ration the available supply among competing buyers, and in a small market with inelastic supply, the price adjustments required can be extreme. Historical precedent supports the plausibility of $250 silver, even if the time frame seems aggressive. In 1980, silver briefly traded above $50 per ounce, equivalent to approximately $170 in inflation-adjusted terms. That spike was driven primarily by the Hunt brothers' attempt to corner the market, an artificial manipulation that ended in market collapse, but it demonstrated that silver can reach extreme price levels when supply-demand dynamics become imbalanced. More relevant is silver's performance during the 2008-2011 precious metals bull market. From its lows in late 2008, silver increased approximately 500% in less than 3 years, reaching $49 per ounce in April 2011. Gold, during the same period, increased approximately 170%. Silver outperformed gold by a factor of 3 to 1 during a period of monetary uncertainty and quantitative easing. The current environment presents many parallels to 2008 to 2011, but with additional factors that could drive even more extreme performance. The monetary expansion following the 2008 crisis now appears modest compared to the expansion since 2020. Debt levels have increased by tens of trillions across developed economies. Central banks have explicitly abandoned inflation targeting in favor of employment mandates and financial stability concerns. The erosion of confidence in fiat currency systems has progressed further. And crucially, the industrial demand factors that are now driving silver consumption barely existed in 2011. Solar installations were a fraction of current levels. Electric vehicles were experimental curiosities. 5G networks didn't exist. If silver could increase 500% during 2008-2011 based primarily on monetary concerns with modest industrial demand growth, what can it achieve in an environment where monetary pressures are greater and industrial demand is growing exponentially? Rickards' $250 target starts to appear not as wild speculation, but as a reasoned projection based on the convergence of forces more powerful than those present in any previous precious metals bull market. The mechanism by which silver reaches $250 before gold reaches $10,000 involves a sequence of market developments that feed on each other. The initial phase, already underway, is driven by industrial demand growth. As solar installations accelerate, as electric vehicle production ramps, as 5G networks deploy globally, industrial consumers compete more aggressively for available silver. This creates upward pressure on prices, moving silver from the $20 range toward $40 or $50. At these higher price levels, investment demand begins awakening. Investors who ignored silver when it traded in the low 20s start paying attention when it approaches 50. Financial media coverage increases. Precious metals analysts who focused exclusively on gold begin discussing silver's fundamentals. Exchange-traded funds see inflows as investors seek exposure. This investment demand adds to industrial demand, further tightening the market and driving prices higher. As silver crosses through $50 and approaches $75 or $80, a critical threshold is reached. At these levels, silver is generating absolute returns that compete with or exceed gold's returns. The narrative shifts from gold is the safe haven and silver is volatile side bet to silver is outperforming gold and offering better risk reward. This shift accelerates institutional participation. Fund managers who allocated to gold begin questioning why they're not in silver, which is delivering superior performance. Meanwhile, retail investors globally are calculating gold-silver ratios and recognizing the historical extremes. At $70 silver and $2,500 gold, the ratio would still be above 35 to 1, well above historical averages. This recognition drives additional retail buying, particularly in markets where gold's absolute price has become prohibitive for average investors. The poor man's gold effect intensifies as silver becomes the accessible way to participate in monetary metal appreciation. At this stage, the short squeeze dynamic activates. Commercial shorts established when silver was trading at $25 are now underwater by hundreds of percent. The financial pain becomes unbearable, forcing covering. As shorts buy to close positions, they compete with industrial consumers who cannot delay purchases, and with investment funds still building positions. The available supply shrinks further. Premiums for physical silver over paper prices widen dramatically. The market fractures into a paper market trading at one price and a physical market trading at substantial premiums. As silver approaches $150, the psychology shifts again. The metal is now generating returns that have captured global attention. Major financial institutions that dismissed silver as too small or too volatile for serious allocation begin reconsidering. Sovereign wealth funds in Asia and the Middle East, sitting on trillions in dollar-denominated reserves, start viewing silver as a strategic resource for their energy transitions and as a monetary alternative. Central banks, which hold virtually no silver in reserves currently, begin tentative accumulation programs. The final phase toward $250 is driven by recognition that silver's role has fundamentally changed. It's no longer merely a precious metal or industrial commodity. It has become critical infrastructure for the technological transformation of civilization and simultaneously a monetary safe haven for populations priced out of gold. This dual role, once seen as weakness, is now recognized as a unique strength that no other commodity possesses. Throughout this sequence, gold is also rising, driven by its own monetary fundamentals, but gold's larger market, more distributed holdings, and singular role limit its percentage gains. Gold moves from $2,500 to $5,000 to $7,000. Impressive absolute gains, but measured in multiples of 2 to 3 times. Silver, starting from a lower base, driven by more acute supply-demand imbalances, and benefiting from ratio compression, moves from $25 to $50 to $100 to $200. Multiples of 8 to 10 times. The mathematics are straightforward. If gold triples from current levels to reach $7,500 and silver increases eightfold to reach $200, the gold-silver ratio compresses to approximately 37 to 1. This ratio is not historically extreme. It's close to the long-term average. The entire projection rests on a return to normal ratios combined with recognition of silver's enhanced fundamental value proposition. For those considering how to position for this scenario, Rickards emphasizes several critical points. The first is the distinction between physical silver and paper silver instruments. In a market moving toward $250 with acute physical shortages, the spread between paper and physical prices could become extreme. Futures contracts settled in cash, ETFs holding unallocated silver or bank-issued silver certificates may not provide the same returns as physical metal in hand. The case for physical ownership becomes compelling when we consider delivery failures and counterparty risk. If the scenario Rickards describes unfolds, industrial consumers desperate for metal, investment demand surging, short covering accelerating, the physical market may simply run out of available supply at any price. Paper instruments may settle at prices that bear little relation to what physical silver is actually trading at in real transactions. Those holding physical metal can demand whatever price the most desperate buyer will pay. Those holding paper claims may discover their contracts settle in currency at prices that don't reflect physical scarcity. The second consideration is timing and indicators to monitor. Rickards doesn't provide precise timing for when silver reaches $250, but he identifies several developments that would signal acceleration of the trend. A sustained break above $60 would confirm that the market has entered a new phase beyond the historical resistance levels that capped previous rallies. Continued compression of the gold-silver ratio below 60 to 1 would indicate that the relationship between the metals is normalizing. Reports of physical delivery delays, rising premiums, or major consumers securing multi-year supply agreements would confirm that the industrial demand story is playing out as projected. Equally important are monetary policy indicators. The point at which central banks lose control over inflation, where nominal yields rise but real yields remain deeply negative, where currency devaluation becomes explicit policy. These developments would accelerate capital flows into monetary alternatives. Silver, as the accessible monetary metal, would benefit disproportionately from these flows. The third consideration is allocation sizing and risk management. Rickards' projection, even if ultimately correct, does not guarantee a smooth path from current prices to $250. Silver is historically volatile, capable of 20 or 30% drawdowns even within a strong bull market. Investors who overallocate and face margin calls or forced sales during these drawdowns may exit positions just before the move accelerates. The optimal approach involves sizing positions to withstand significant volatility without forced selling, allowing the fundamental thesis time to play out. The skeptical response to Rickards' projection typically centers on several objections. The first is that $250 silver is simply too far removed from historical experience to be credible. Silver's all-time high was $50 in 1980. Projecting prices 5 times higher seems like fantasy. But this objection fails to account for the fundamental differences between current conditions and any previous period. The industrial applications driving demand in 2024-2026 did not exist in 1980 or even 2011. The monetary expansion and debt levels in the global system dwarf any previous period. Comparing today's silver market to historical precedent is comparing different markets entirely. The second objection is that high prices will trigger substitution and demand destruction. If silver reaches $250, manufacturers will find alternatives, use less, or accept performance compromises. This objection has more validity for some applications than others. In jewelry or decorative uses, substitution is certainly possible. But in the critical industrial applications driving demand, solar cells requiring maximum conductivity, EV systems needing thermal management, 5G infrastructure operating at precise specifications, substitution is limited by physics. Engineers have spent decades attempting to reduce silver content in these applications. The low-hanging fruit has been picked. Further reductions compromise performance below acceptable thresholds. The third objection is that mine supply will respond to higher prices, flooding the market and capping gains. But as discussed earlier, silver's supply curve is largely inelastic in the time frames relevant to Rickards' projection. 70% of production is byproduct of base metal mining and won't increase unless copper, lead, and zinc economics justify it. Primary silver mines take years to develop and expand. Even if developers broke ground today on every marginal silver project globally, the new supply would arrive too late to prevent the price spike Rickards describes. Perhaps the most sophisticated objection is that governments will intervene to prevent silver from reaching destabilizing price levels. If silver becomes critical to solar panels, EVs, and telecommunications infrastructure, and if price increases threaten these industries, governments might release strategic stockpiles, impose export controls, or even nationalize mining production to ensure supply. This is a real risk, but it cuts both ways. Government intervention in commodity markets typically confirms rather than refutes the fundamental shortage. If authorities must resort to emergency measures to control silver prices, it validates the thesis that the market is profoundly tight. Moreover, stockpiles have already been largely depleted. The silver available for government intervention is limited. The implications of Rickards' projection extend beyond investment returns for those who position correctly. If silver reaches $250, the entire renewable energy transition faces significant cost increases. Solar installations become more expensive, potentially slowing deployment and affecting climate targets. Electric vehicles see bill of materials increases that either compress manufacturer margins or raise consumer prices. The telecommunications build-out required for 5G and future networks becomes more capital-intensive. These cost increases could force difficult policy choices. Governments committed to rapid decarbonization must either accept slower progress, increase subsidies to offset higher material costs, or prioritize domestic silver production through whatever means necessary. The geopolitics of silver becomes as contentious as the geopolitics of oil, with resource-rich nations leveraging their position and resource-poor nations scrambling to secure supply through alliances and strategic investments. For the financial system, $250 silver represents validation that precious metals remain relevant monetary assets despite decades of fiat currency dominance. It would force reassessment of central bank reserve compositions, potentially triggering a scramble for monetary metals that accelerates both gold and silver prices further. The derivatives markets built on assumptions of stable precious metals prices would face severe stress, potentially requiring intervention to prevent systemic disruption. For ordinary investors, the trajectory Rickards describes offers opportunity and challenge simultaneously. The opportunity lies in allocating capital to an asset positioned to benefit from multiple powerful trends: industrial transformation, monetary uncertainty, and historical undervaluation. The challenge lies in maintaining conviction through inevitable volatility and skepticism from conventional financial advisors who dismiss precious metals based on decades of modest performance. The recalibration that Rickards describes is not merely about silver's price, it's about recognizing that in a world transitioning to renewable energy and electric transportation, while simultaneously experiencing monetary instability, certain physical resources become more valuable than the financial instruments that dominate modern portfolios. Paper assets, stocks, bonds, currencies, exist as claims on future production and financial engineering. Physical silver exists as a tangible asset with properties that make it essential to technological systems and impossible to replicate. This distinction becomes critical in scenarios where confidence in financial systems erodes. When investors question whether bond yields will keep pace with inflation, whether equity valuations are sustainable, whether currencies will maintain purchasing power, they seek alternatives with intrinsic value and utility. Silver qualifies on both counts in ways that few assets can match. The prediction that silver reaches $250 before gold touches $10,000 represents more than a forecast about commodity prices. It's a thesis about the relative scarcity that matters most in the emerging world order. Gold is scarce, certainly, with limited annual production and concentrated central bank holdings, but silver is scarce in ways that affect daily life and technological progress. The inability to produce sufficient silver affects whether solar panels can be manufactured, whether electric vehicles can be built, whether communication networks can expand. This scarcity has immediate, tangible consequences that gold's scarcity does not. When Rickards states that silver hits $250 first, he's arguing that markets will recognize this differential scarcity and price it accordingly. The industrial imperative to secure silver supply, combined with monetary demand from investors seeking accessible precious metals exposure, creates price pressure that exceeds what gold experiences from monetary demand alone. The math may seem extreme, but the fundamentals supporting it are increasingly difficult to dispute. For those tracking these developments, the indicators are already confirming the thesis. Silver's price volatility is increasing, suggesting growing interest from speculators and investors. Industrial consumers are lengthening supply contracts and building inventory cushions, behavior consistent with expectations of future tightness. Mining companies are seeing valuation multiples expand as markets price in higher long-term silver prices. The financial media is beginning to discuss silver more frequently, shifting from dismissive coverage to serious analysis. These early signs don't guarantee Rickards is correct about timing or specific price targets. Markets are complex systems influenced by countless variables, many of which remain unpredictable. But the directional thesis that silver is undervalued relative to its industrial importance and monetary role, that supply-demand imbalances will drive prices substantially higher, that silver may outperform gold during the coming precious metals bull market appears increasingly supported by observable reality. The choice facing investors is whether to position for this scenario before it becomes consensus. By the time silver reaches $100 and Rickards' projection appears validated, the easiest gains will have passed. The opportunity exists now, while silver remains below $50, and most investors remain focused on other assets. But opportunity comes paired with risk, the risk of being early, of enduring volatility, of holding convictions that diverge from mainstream thinking. Jim Rickards built his reputation on being willing to hold such convictions when analysis supported them, even when they seemed extreme. His call for $250 silver before $10,000 gold fits this pattern. It seems outlandish until you examine the fundamentals and realize that the outlandish outcome may actually be the logical one given the forces in play. The recalibration he describes is not speculation, it's recognition that silver's role in the global economy has fundamentally changed and prices must eventually reflect this new reality. Whether that reality manifests at exactly $250 or some other level, whether gold reaches $10,000 or stops short, the core insight remains valid. Silver's moment has arrived, driven by forces more powerful and persistent than any that have affected the metal in modern history. Those who recognize this transformation early and position accordingly may find themselves benefiting from one of the most significant commodity repricing events of this century. Those who dismiss it as impossible may find themselves explaining why they missed what, in retrospect, appeared inevitable.